Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. We also have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, founder of the internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business Financial blog. Finally, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy, and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, please check out our people section at www.nucleuswealth.com. Yes, so hello and welcome to this week's instalment of Nucleus Investment Insights. And today we're going to be looking at the recent results and shakeout from the US midterm elections, generally known to be a pretty tumultuous time for both voters and markets. So we thought we'd do a little deep dive into it and how we reflect these things every day at Nucleus Wealth. I'm joined today by Chief Strategist David Llewellyn-Smith. Hello, David.
Hi, Tim.
And our Head of Investments, Damien Klassen. G'day, Damien.
Hi, Tim.
Really looking forward to this one. For those that are watching, I'll just let you know that this one is probably the least chart-heavy slide or presentation that we'll have, which is good news for those listening in on the podcast. So we're going to kick off with an agenda and also the only slide for this presentation, just as an FYI. And we're going to be kicking off with China and the trade war, looking into some tax cuts, infrastructure, stalemate, and oversight and potential impeachment. And then finally, of course, as always, the investment outlook for how we run money every day here at Nucleus Wealth. So who would like to begin the proceedings, gentlemen?
Over to you, David. Let's talk trade. So we want to talk China trade war at the moment. So David's obviously been blogging about this prolifically on the site.
I have, yes. So, excuse me. There are probably two ways of viewing the election results in reference to the trade war. One is if you think that Trump has been weakened by the Democrats taking the House and therefore clogging up some potential fiscal stimulus or tax cuts or other policy that he might have had in mind, then you would see US growth slowing and therefore greater motivation for Trump to do a deal with China that would boost markets. That's not really the way I see it. The second way of viewing it is really through the prism of, I guess, what you'd call American nationalism, and that is, I think it's fair to say that the Democrats are, at least historically, even more hawkish on China. Obviously they have stronger connections to the US trade unions, what there is of them. They're pretty weakened, but they're traditionally coming from more of the left on the spectrum, stronger relationship with US labour, etc., and so greater sympathy with the fallout from the globalisation of the American economy. And deindustrialisation. So, that has a kind of contemporary cutting edge for them, because it was really that constituency that abandoned them for Trump during the presidential election. because
and as well, it's worth saying that Bernie Sanders ran a pretty close second to Hillary, and that was pretty. A lot of these policies were policies which we see he probably would have enacted if he had made it.
That's right. So I think the more likely outcome is that it doesn't really impact Trump's agenda. It doesn't have any practical implication for him. POTUS has a lot of power when it comes to trade, so he can still proceed with his 25% tariff hike early next year. It's not going to inhibit that. And I'm of the view, we're of the view that it's unlikely to mitigate the trade war in any way, having more Dems having more power. We think that that shift to Cold War 2.0, if we can call it that, is structural, not cyclical. That said, I've been tapping into my China networks to, try and figure out, what China's view on things is, and I'm being told that, China is a bit bemused. It's prepared to do a deal that would erase the US deficit with China, but as we've seen over the last few months, that what appeared to be tariffs only initially migrated very quickly into really being about tech and intellectual property, and actually China's next phase of growth and how that was going to impact US power.
And when he's talking about the cutting out the deficit, that was we'd spoken a lot earlier, very early in Trump's presidency, about the easiest way for China out of that was to just buy all its oil from the US, and which doesn't really make much of a difference from the whole world perspective, because the oil just shifts around, and Middle Eastern oil that would have gone to China ends up going to Europe, and American oil and then American oil that might have gone to Europe ends up going to China. So you're really just shifting your transport around a little bit. But that would have fixed the sort of bilateral trade without fixing any of the structural issues. But at least that would have been like a nice big sort of win for Trump in terms of changing very, very little, but giving him a headline win. Whereas it does seem as if they are actually looking for something more structural.
And same with LNG, of course. That's right. I think they are determined to knock Chinese tech on the head. The stealing of tech, also just tech development. They don't want to see China rise up that value chain any further. I don't think that's realistic, but at least not quickly. That's a direct threat, both to US leadership in that space, as well as US power. So, because obviously it can be weaponised and militarised, what have you. So, therefore, on question one, we don't really see any change coming out of the midterms.
And similarly, then the same line of thinking applies for Australian resources and China gearing up potentially, as we've mentioned in previous podcasts.
It does. As the corollary of a persistent trade war, you will see China build more stuff. Yes, so we still have a relatively strong outlook for the bulk commodities next year. Not really base metals. And that's already been reflected in market pricing over the last few months. We've more or less got that right so far. I think that the bulks will probably come off over the next few months, at least sort of heading into New Year, tends to rally then. But just as we kind of wind down in China into winter and some of the shutdowns and what have you, but it still looks like in prospect a reasonable year for bulk pricing.
Yeah, it's probably. I guess as a broader overview, the results from the election were pretty much expected by most of the betting sites, and most of the polling was the results were pretty much expected that the Democrats would get the House and the Republicans would end up with the Senate. So from our investment outlook, we're positioned pretty much for this type of outcome. There was potential that polls would get it wrong, as they did at the last election. So I guess there's probably more heightened risk around these, just in terms of what did the pollsters learn from their mistakes with the last Trump version. But as a broader overview, that was certainly we are expecting a similar outcome. It's worth noting as well, just on the whole resources bit. As it's well worth highlighting that point, as David was saying, that the slowdown. So just for anyone who hasn't listened in to the full sort of resources view on other ones, we're expecting that the trade war will lead to a big slowdown in China, and we're already seeing that happen. There's some winter shutdowns as well, so it's going to look worse before it looks better. And at the same time, the only real accelerator that China has to keep their economy ticking over is to push the infrastructure and push property building, which they appear to be doing. And that's very good for the bulk commodities, but it's positive for base metals, but the negatives for base metals will on the whole industrial slowdown, we think will more than offset the positives from the building sector.
So net, you end up with probably still slowing growth in China, just a different composition and coming off more slowly than the trade war would have had it.
Okay.
The other thing which will be interesting to see in terms of the China trade war is that there's a view circulating that China is basically looking at the US and saying the US is more fractured than ever in terms of the political output, which seems right. And their response is that, well, if we apply some pressure and China and we can take a little bit of pain. If the US takes a little bit of pain, then it'll all fall to pieces. The flip side is, I think that's wrong. I can see where that may be the view in China, but personally, we think that's something which they've got wrong. Is that both the Democrats and the Republicans will coalesce, behind an outside enemy rather than fracturing and.
Going from there. Okay, very good. We'll jump on to number two, being the tax cuts. So obviously, depending on what side of the fence you sit on, that was potentially a strong point of Trump, and then a largest to the markets essentially in asset pricing. Would you agree? Or
yeah, so I think there's two parts to this. One is the company tax side. Trump wanted lower company taxes, and I suspect if they had ended up with a majority in both houses, the Republicans, they may well have tried to push taxes even further. So we don't think there's going to be any action on that, but we'll keep an eye out. On the personal side, it's worth noting that a lot of the benefit to the low income groups expires after a certain period of time. And so it was a positive to low income groups for the first year or two, and then actually switched around to be a negative, and as other things expire. So we think there's a deal to be done there, and that Trump's happy to have tax cuts. The last set of tax cuts were substantially targeted towards the richest part of the economy, and that's the part that actually you get the least bang for your buck, because most of the tax cuts end up being saved. And the benefit of giving tax cuts or to the lower income part is usually that money just pumps straight back into the economy and gets to circulate and bring jobs down and wages up and things like that. Unemployment down and wages up. So we think there's potential for a deal to be done on at least extension of some of the tax cuts for the lowest economic groups, and potentially even more of some more tax cuts.
But essentially, no opposition to them, though.
No, I think you'll find there won't be any more. There won't be any more tax cuts for the richest part. But I think if there's a bit of I think the argument that you guys already got all your benefit in the last round. Now it's time for the poorer people to actually get a bigger share. I think amongst the Democrats that would find significant support.
Okay, very good. Anything on tax cuts, Dave?
No, I agree with that assessment.
It's sort of it's not like it's a massive probability, but it's certainly out there that could be one more thing to throw a little bit more kerosene on this late cycle fire that we've got going.
Absolutely.
I mean that's something we should note. Trump is obviously going to be desperate to keep the economy going as strongly as he can for 2020, especially having just been owned in the House. Although it wasn't a huge clubbing or anything, and they won more in the Senate, but it's a warning across the Republican bowels. So he'll want to keep the economy going. He'll certainly be looking for what we've discussed many times. In part is some of these expiration of tax cuts, but the fiscal cliff that we see in the US that comes up mid next year, and there's a sort of automatic slowing in growth through the latter half of next year, we've discussed many times, and he'll be looking to offset that by doing deals. And tax cuts, like what Damien's described, may be part of it. Yeah.
Okay, all right. We'll roll into number 3, being infrastructure. So is this an area of where the Democrats are going to stoke it up? I've read traditionally this is something that is looked at.
Well, they, excuse me, I mean, 2 and 3 come under the same sort of heading, which is, Trump looking for more domestic growth, more domestic demand. And infrastructure is an area, again, where there's a lot of crossover with democratic values. We know he's had his $1 trillion infrastructure plan in the back of his mind for a couple of years. They sort of ran afoul of the Democrats a bit in terms of figuring out how to fund it. They had different ideas about how to fund it. I think the Republicans wanted to raise some taxes, oddly enough. So, we think that this is probably the hottest item, off the block in terms of where they could find compromise going forward. And indeed, last night, Nancy Pelosi, Speaker of the House, or former Speaker of the House, likely to be reappointed, was immediately very constructive on doing a deal over infrastructure. And Trump was the same. They were, amid a lot of mudslinging and poo throwing, the one thing that was positive and everybody could agree on was actually infrastructure stimulus. There's a great need for it. Everybody knows that the US capital stock has been deteriorating badly for decades. So it makes it's actually sensible, which is unusual for Donald. And it is agreeable to democratic values, absolutely. So we think that's the most likely prospect for further stimulus.
It's also the biggest risk, I guess, in terms of US growth. If, as David said, there's this fiscal cliff coming mid next year, and where all these benefits that have flowed through from lower taxes, all of a sudden finish, and if you the question is, will the economy, is that enough to kickstart the US economy, and will it flow on? And if it isn't, and we don't see an infrastructure spend as well because they get caught in the stalemate, then there are risks, possibly even some quite significant risks to US growth. And so it's probably the biggest swing factor of all those in terms of a positive and negative, and certainly the one we're going to be keeping a pretty close eye on in terms of infrastructure spend. The other thing is, to Trump's credit, and there's not that many things, obviously, I think you have to preface that whenever you compliment Trump. But to Trump's credit, the reality is most of the stuff he's doing is what he said he'd do. He ran a list of things that he was doing in his pre-election, and he's sort of pretty much going through and checking off things on that list. If you are a political strategist with a decent time frame, which I suspect he probably has got a few Republican guys sitting around him that do have that sort of a bit of forward thinking, is that you would have gone, okay, what we want to do, we want to fix the healthcare, we want to get tax cuts through, we want to get some infrastructure spend going, and we want to fix up things with China and trade wars. Is you would have gone through and knowing that quite possibly in 2 years you would have lost your majority in one or at least one of the houses. The one thing you would have gone is, okay, what can we still get through with the Democrats, and the infrastructure made the most amount of sense to say, well, let's put that last, and let's get these other things out of the way first while we've got a majority.
Got the majority, yeah, sure.
And then because that'll give us scope to still do something on the infrastructure. And obviously you can't do everything at once, but with an idea that if you're sort of doing 6 monthly intervals of here's our tax cut 6 months, and here's our repeal Obamacare one, and they obviously didn't get up on that, but you're
leaving a bit of low-hanging fruit for something can get through.
So it makes a lot of sense, but it's not a foregone conclusion.
No, and there is a risk in it, a political risk in it, in how bloody minded the new Dems are as well. Like, if they decide that every man and his dog knows that the US slowdown is coming in the second half of next year, partly the fiscal cliff and partly Fed tightening. And, that's only a little over, it's roughly 12 months out from the next presidential election. And if the Dems wanted to get really bloody minded, they might just say, well, we don't really want to stimulate the economy. We'll just let it fade away, and you can carry the bag, into the 2020 presidential election.
Which was pretty much what the Republicans did for Obama. Obama had a number of big stimulus packages he wanted to put through in terms of these, and they very much stonewalled and wouldn't let a lot of stuff go through. Yep. So there may well be payback in terms of that.
Yeah, it's possible.
Having said that, they generally seem to be more, more rational in terms of...
I think so.
Let's get the best outcome for
Though less so
the country
since Trump came along.
Exactly. Yeah. So, we often joke internally that if Bernie Sanders had been elected and run a lot of these same policies, that everyone who's currently for the policies would be against them, and everyone who's currently against them would be for them. In terms of there's a decent flip around. There's a lot of people with quite malleable opinions, but we do think there's probably more likelihood that. Even if you do have a quite extreme bunch of people within the Democratic Party who are like, no, we're just voting, whatever Trump says, we're voting against it. We do think there's enough that would cross the floor for things like infrastructure, and especially when you're spending big money on infrastructure.
And that's the thing, they don't need many still.
No.
Even after losing the House. I mean, if they can pork barrel into those Dems electorates.
Exactly. We're just saying we'll slice you off a few $1 billion for a pet project you have in yours.
Yep.
How'd you like to vote for us? It's pretty compelling for most politicians.
This bridge will be great. It'll be the best bridge ever.
Biggest bridge in the world. Okay. So is that that was stalemate?
No,
it's
sort of starting to get into stalemate.
Yeah.
I think there's a number of other things we just expect to stalemate on. So whether it be healthcare is probably your biggest one in terms of will you get any more in healthcare? I think in terms of regulations, I think we've probably seen as they've cut back as many regulations as they can by sort of without having to go to parliaments. I think there's limited scope for those to be cut back any further, and so I think there's a whole bunch of areas where we're basically not going to get any action, and it's not that's not such a bad thing for a lot of these, because I think you're already on a bit of a growth path for it. There's certainly social issues I think that will be a bad thing for, but in terms of economic growth, having stalemate and not doing anything in a number of these areas, and healthcare is probably your biggest one, is probably a good thing.
Okay.
Yeah, markets tend to quite like the stalemate. Just comes with no surprises.
Yep. No, that's fair enough. All right, we'll roll into oversight and potential impeachment. Yeah, this will be interesting.
Yeah.
What have you got?
Well, look, I mean, there's lots of issues with Trump's been very willing to mix his business deals and his government things all within one. And certainly from a traditional point of oversight and traditional point of not hiring family members and all that type of stuff, he's been more than willing to buck the trend, and the Republicans haven't sort of held him to account on any of that. So I think there'll certainly be a lot more. We'll get a lot more noise on this front. The issue is the Senate. Will the Senate actually? So if you do get any anything raised within the House, will the Senate then look to impeach? And it does look like it's unlikely. I mean, they seem to be holding pretty strong, and the fact that a lot of more moderate Trump supporters lost their seats, I think you've actually got a more extreme Senate.
Okay, that's interesting.
And also just a bit of a, you're more likely to, the people who are there have seen a few of the moderates go, and so they're more likely to toe the party line and vote with it. So I guess what we're thinking is, unless you see something quite extreme, so some and it's potential that exists in terms of real criminal behaviour or real overstepping of the boundaries or something coming out of the Russia probe that's
you can only hold your breath, can't you?
But we think for the minor, the sort of the grey area, we think it's the House will vote one way and the Senate will vote the other way.
But is that going to create in itself a problem, because you've got now effectively like a hanging jury that's just come in now to sort of say, okay, now we've got a bit of power, let's exercise it and pull out all the, the skeletons out of the cupboard that we've seen get aired and then tucked away quickly and aired and tucked away. Is that going to? Do you think that's going to be it's going to stymie progress?
Yep. It's a stalemate. That's why we're in a stalemate.
Yeah. So I don't see that as really material economically or in terms of markets, but it's definitely going to happen. Yeah. Like the house has a subpoena power and stuff. Yeah. They can definitely ramp up the background noise, and then it comes down to whether or not they actually can dig some real dirt, and who knows.
Yeah, because I think a lot of the grey stuff, the Republicans just waved it away when they had both houses. Now it'll get aired a lot more, so they'll sell a lot more newspapers. There'll be a lot more noise on various TVs, but unless there's something that's black and white,
like systematically,
it's hard to see that you get to impeachment. Now the question as well, once you do get to impeachment, if you did, what's President Pence going to look like? It's pretty hard to tell economically that there's going to be too much difference. I think, especially if he had only had a year to run in the... so if he sort of went through a whole impeachment process that kicked off pretty quickly and came to conclusions pretty quickly, President Pence, the main thing he seems to stand for is, quite Christian values and rolling back some of the social issues. Economically, he really hasn't progressed anything that's different to Trump, and he actually delivered the whole the initial sort of salvo in that in the whole Cold War thing, he had quite a long speech all about the issues with China. So my expectation would be, with say a year or 6 months to run before an election, there's basically very little that he would actually get done in that scenario. So I think if you're expecting that Trump will get impeached and all of a sudden we'll have a new president and things will be wildly different, my view would be that he'll get impeached. President Pence will probably do a few sort of social issues to pander to the quite religious base. But economically wouldn't be too much different.
So chances of impeachment in the next 12 months, fellas? What do you think?
Whatever the betting markets are saying at the moment.
Not great to half a chance, perhaps.
As I said, I think the bar is going to be quite high. Yeah. If the Democrats had both houses, then I think that they'll certainly find. It appears from what's been found so far, I think you could certainly find enough grey material that if you had both houses, you could successfully impeach. I think that given you don't have both houses, that and you need to find something more.
And my understanding is it's a pretty protracted process anyway. So as soon as it's even on the cards, it's not going to happen for a year, possibly, is it, or something like that? I think it was 9 or 12 months, depending on
It'll take a while.
So then, from a market perspective, it's it's probably baked in by the time it even happens. Surely. All right, very good. And then we'll zoom into the final investment outlook. So I guess would we like to break...
Just quickly on that though, you would see, certainly at the start of it, you'd have very volatile markets. You'd see markets, I would expect you'd see markets fall if that was the case, just on the back of uncertainty. Markets don't like uncertainty, and so until...
All right, fair enough. Okay, so into investment outlook. I guess, how do we want to approach this one? Look at the sectors, or what are the areas of focus now?
Why don't I kick off with a bit of Aussie dollar, maybe?
Yeah, do.
We saw, pretty sizable rally in the Aussie dollar when the Dems got through, when they won the House, when it became apparent they were going to win. Largely on the back of a falling US dollar. That's kind of reversed a little bit today, and right now, markets have gotten extremely short on the Aussie dollar, which is one of the reasons why, we've had what you can only describe as, I suppose, lukewarm positives for Australia over the last couple of weeks. And that's been enough for the dollar to have a pretty reasonable rally off the lows. It hit 73 cents last night, and a lot of this is just shorts puking positions because, it's almost like it can only go one way right now because everyone's on one side of the boat. So I don't think that this is a real shift in in the falling Aussie or the rising US dollar, for all the reasons we've discussed already. Probably the principal two is, the tariffs go on, which continues to raise US inflation versus just about everybody else. We do get a little more stimulus, which keeps the Fed busy much more than anywhere else. And you've still got this surging wage growth in the US, which, although it is not rocketing, is certainly firming very quickly. And so, as they say, Forex is a beauty contest, not a race to the finish line. So I think you've got a slowing Europe, slowing China, China under a lot of pressure from tariffs, etc. Japan just, doing what Japan does, but where else are you going to go, I guess is the question. And so still see the US dollar as quite firm, not really changing that outlook, despite the fact that, some kind of stimulus options have been cut off by the Dems taking the House. And it's still, all of these structures or variables are still very difficult for the Australian dollar, so don't see that rally persisting very far either.
And I guess from a broader view, like our basic take is we, as the Aussie dollar sort of sold its way down, we sort of got rid of some of our sort of cash holdings, our offshore cash holdings. Question for us is if it continues to rise from here, we'll probably look to pick up increase our cash holdings. We're pretty happy with our equity positions at the moment. So
we sold down a lot of the dollar exposed stuff locally as well.
Yes, yeah. Our dollar exposed ones. It was a mixture of the Aussie dollar falling, but also as well just very expensive. Like that's a whole sector of that economy got so expensive we just couldn't hold the positions any longer. So things like Cochlear and we got out of completely. CSL, we went from being extremely overweight to underweight, just on the back of the pricing for that sector just got to extreme levels. So if the Aussie dollar rises, we might pick up a few more of those names, provided they've come back in value.
Okay.
I think in terms of international positions, our broad take was as the market ran up, we were switching our position. We were sort of taking some profits and switching our positions from the more growth-oriented sectors to the more consumer staples, to the safer sectors.
Okay.
As the market fell, what we've seen is those consumer staples have really outperformed the growth part, and now we're starting to do a bit of a switch back.
Okay.
And so we've been spent the last few weeks sort of switching that back, and not in a big way. And we've picked up some more equities as well. So we lightened up on equities as the market rose. Market fell, we picked up, sort of increased our equities weighting, and if we continue to see the market rise as we've seen, we'll just wind that back again. So we sort of feel as if we're in a position where we're going from quite underweight equities to moderately underweight equities, and just sort of with the market. If the market keeps rallying, we'll just become more underweight. We do think there's scope for another 12 to 18 months before we see the end of cycle. Maybe it'll be earlier, maybe it'll be later. Where we don't want to be too dogmatic about it or too specific about picking a time. So we're still keeping lots of cash in reserve, but we think that for the large part we've still got another 12 to 18 months and maybe longer if we get a little bit more movement on tax cuts, and you get some big infrastructure spends in the US. You could easily see this cycle maybe even go another 2 years.
Just keep powering on. Okay. Thanks for that. We've got a quick question here, actually. I'll allow either of you to answer this one, but it is, so when does US government debt become an issue? Individual states seem to be even worse. Connecticut is given as an example, and they all seem to be heading towards bankruptcy. So US government debt, where does that play into our thinking?
Well, I've got one word answer for you. Japan.
Right.
Never.
Yep. Okay.
Yeah. I mean, it's obviously an issue if you've got a monetarist paradigm, which sees unsustainable fiscal positions as difficult and very troublesome for your currency. But if you and really difficult if you see the world as inflationary. But if you accept that we're in a structurally lowflation world, which we think for various reasons, then your monetary policy comes to the rescue of fiscal You know, you can just buy your own debt, which is what we've been seeing for decade after decade in Japan, and I expect, you know, much the same process will transpire in the US, where whenever we get the next accident, there'll be some more monetary innovation. It may integrate with the infrastructure stuff, for instance, where you get a sort of form of quantitative easing for the people rather than just for banks and financial markets, where, you know, the Federal Reserve starts to directly fund certain accepted, economically positive fiscal spending.
And so just to break that out though, so obviously you've got US federal debt and obviously reserve currency status helping there. How does that then relate to, perhaps, I think with this gentleman here, at a state level, is it much the same? You can just use the same approach?
Well, as long as you've got excuse me, as long as you've got growth, it's going to help the states overcome any deficits that they have.
Yep.
I mean, I'm not an expert on the state debt, and I can certainly say that, you know, having been through the GFC and looked at that quite closely with local and state government debt in the US, it became a huge problem for them, and exacerbated the downturn for some years as they went through austerity. And you may well see a sort of political pushback to that of some sort that, you know, would exacerbate the next downturn. But again, you know, that doesn't really apply at the federal level. You know, if you've got your own currency, you know, we're sort of entering the era of modern monetary theory, which is slowly overtaking a monetarist period in markets, as all of these major currencies and economic blocks, you know, just become so heavily indebted amid, you know, really declining demographics, that the deflation is so structural that they really, you know, have two choices. They can not bail themselves out by printing money and have a depression, or they can just go ahead and do it. And, you know, faced with that kind of simple choice, governments take the obvious road.
Print every day of the week.
Yeah, that's right. Yeah.
Okay.
So, I mean, that's a long-winded answer, that I think we'll probably see something similar come to here as well.
Yeah, right, okay.
Yeah, so very much look at Japan as your template for, and they're running, is it 300% yet? I don't know.
Yeah, it's a lot.
It's over 200% in terms of the government debt, and they just they're out buying
equity.
They're actually out buying equities. They're buying, in terms of their quantitative easing, they're buying, you know, government debts. They're buying corporate debts. They're just, you know, that's how they've tried various ways of getting money directly out to the people. It's just they're trying to get inflation going, and they just cannot get inflation going. Now they're a bit more extreme in terms of the demographic slide, but you know, the conditions we see in Japan, we think will spread to a number of other countries, and they're a good example of a country where they just keep pumping the debt out and then self-funding it between the central bank, which is really just a bit of a sleight of hand in terms of whether do you tax people more and then give it, or do you just give them below market interest rates and below inflation interest rates, and then use that money that you've picked up there to pump back into the economy. And so where you do have to watch for ones is not every country can obviously do that, and you do hit certain extremes where you hit you know, like in Argentina or Venezuela, where you start you get into the quite high inflation rates, but the US is nowhere near that, and I think that, you know, that bucket loads more spending before you get anywhere close to having that as a major issue.
Okay, all right, fantastic. Well, on that note, we'll jump into some information about Nucleus Wealth. Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency of what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio managed daily by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for Cash Management and JP Morgan, one of the biggest banks in the world, as custodian of your assets. In our new personal superannuation option, we have partnered with Praemium, who is backed by HSBC as custodian and ANZ for Cash Management. We feel these structures are the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment to ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating only the areas that are important to you, you avoid missing out on the potentially higher returning areas that you are ambivalent about, which are often ruled out in other broader ethical investment options currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they have experience in. We also offer a complete investment solution for those who don't have the time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.
Okay, yes, and as I will continue to say for probably till the end of the year, I'll just remind everybody that our personal superannuation option has come out recently. It gives you the opportunity to use your super money in a retail fund or a personal super fund to invest with us. You can do everything you can do outside of super, so select your ethics. You can also compare your fees. We've got about the top 40 largest superannuation funds in Australia listed in. We've keyed in their fees, so you can give yourself a point of comparison there. You can also get help around structuring the investments and setting up the risk levels, and also seeking further advice as well. So head over to portal.nucleuswealth.com to begin the onboarding process, and feel free to be in touch if you need any help. Coming up next week, we've got on our next Nucleus Investment Insights, we've got a continuing viewpoint on the Australian housing crash. So I think even Blind Freddie realises now that it's well underway. So we'll get some facts and figures and give you our take on it, and how, of course, it affects the investments at Nucleus Wealth. So that's Thursday, the 15th of November, same bat time, same bat channel, and just head over to the Nucleus Wealth live webinar page to view that one, and of course have your questions answered live. As always, we are available on iTunes and wherever you get your quality financial podcasts from on Android. Podcast Addict jumps to mind. If you like what you hear, feel free to give us a review or 5 stars, or give us a like if you can as well. That just helps get our message out there and build our viewership. So might be much appreciated. And as always, thanks very much for attending. I hope you got something out of it today. I certainly did. If you'd like to head over to bit.ly/Nucleus survey, you can give us a bit of an idea of how we've gone today, and of course drop in any topics you'd like to hear about in the future. So on that note, thanks again for listening in, and I look forward to catching you at the next one. Cheers.